the revisions to the last 2 months of job ads dropped 250,000, over 250,000 jobs, which you haven't seen an adjustment like that since the 60s.
This is probably the easiest time in human history to buy a house.
I think the experienced investors weren't as concerned with the tariffs and things like that.
We were in negotiations investing in real estate. They're winning, they're making money.
What's up, everyone? Welcome to the Real Estate Educators Podcast, where we provide the education you can build on. I'm your host, Kevin Amolsch. We are back. Another market pulse from Minneapolis. We have our good friends, Sean and Mike, with us today. I know you love these market pulse episodes. So if you could do me a favor, hit like, hit subscribe, help us out. We're trying to build a community to help more real estate investors just like you. So give us a 5-star review and help us grow the podcast. So we are back with the same guests. They need no introduction, but quickly, if we could, maybe I'll start with you, Sean. Quickly, who you are, what we're doing here, and then let's get Mike going.
I'm Sean Blomquist with Pine Financial Group. I'm your representative here in Minnesota. So if you're doing deals with Pine Financial Group in Minnesota, you'll be dealing with me in some way, shape, or form. So I'm glad to be here.
Yeah, we love having you as a co-host for these Market Pulse episodes. So Mike, tell us who you are.
Yeah, Mike Jacka, president and founder of the Minnesota Real Estate Investors Association, and a full-time investor, just out there grinding away, trying to do deals here and there, and trying to help out and educate other investors and in the local Twin Cities market.
All right. Well, we always love having you on here, Mike, because you have such good insights into what's going on with the housing market and the housing economy, I guess, in your backyard. So thank you again so much for giving us your time and coming out here and enlighten us a little bit. I don't know if we want to get into some of the macro stuff first, and then we'll dig into the micro Minneapolis, but I think that's probably a good way to go because of the recent jobs reports and this, the CPI inflation going up. So we have a little bit of conflicting data, I guess, for the Federal Reserve to deal with. And I think they meet on the 17th, and everyone's saying interest rates cuts are coming. But is that really going to happen with inflation going up? What do you think?
Well, I'm kind of leaning against what everyone else is thinking, the general consensus, and I don't see the necessity for a rate cut right now. And you listen to Jerome Powell, he doesn't see it. I know he's getting a lot of pushback from other governors, and they're trying to chase them guys out. They're trying to chase other people out who are naysayers. But I know Trump definitely wants Jerome Powell to cut rates, but the numbers don't indicate it. The numbers don't support it. And I think the biggest reason people are saying they need to cut rates is because the housing market is so out of whack. And that's true. I mean, if they cut rates, yeah, it's going to help us for a temporary time frame. But you know what that's going to do? Make it 100 times worse for us in the near future.
Possibly, yeah.
Yeah,
I
so
agree.
then what do we do? I'm under the opinion that we needed to rip the Band-Aid off and let it heal. Right? Rip it off quickly like I did, let it heal, and don't try to reopen the wound. And I think by lowering the rates, you reopen the wound.
Yeah, I sort of agree with you. I don't know that the Fed does, and I know for sure the market doesn't. If you look at the Fed Watch tool, which takes basically what's going on in on the trading floor, like what they look at is the futures of the Fed's decisions. So it's really weird, but basically they're polling the institutional and investors, and what do you think is going to happen at the next Fed meeting? And it's almost 90% chances of a cut right now. But I agree with unemployment being low, inflation on the rise. I don't see a need. What are you thinking, Sean?
I was going to say the same thing. I mean, based on those two numbers, it doesn't make sense, even though they've got the pressure coming from both Trump and the market itself that they want them cut. But I just don't think I'm under the same impression as you guys. I don't see it being a necessity, but in the end, we'll really just see what it comes down to if they bend to market pressure and bend to Trump wanting it to happen. So,
And we'll see what Jerome Paul does in a couple weeks here, but I'm betting he's not going to, but I'm not putting a lot of money on that.
I think he is going to, just because the market is expecting it now. And one thing about Jerome Powell he has been good at is trying to meet expectations. Like he doesn't want to throw a wrench into the economy. So now that it's expected, I think he's feeling his own pressure.
Yeah.
And I think it's because some of the comments he made from the Jackson Hole meeting, one, and two, here's why I think this, Mike. The most recent unemployment numbers, even though unemployment rate only barely ticked up, I think it's 4.2 right now, which is still really low. The revisions to the last 2 months of job ads dropped 250,000, over 250,000 jobs, which you haven't seen an adjustment like that since the 60s. So I think that's a pretty devastating jobs report. Now, we do have another jobs report and 2 more inflation reports before they meet again. So I guess maybe it'll be more clear by the time they meet. But
Well, yeah, you're right there with those adjustments, but I don't know how that's going to play out right now. But I will make this prediction. Rates will come down.
I agree.
The question is when? Are they going to come down now or are they going to come down later? So my prediction is that Paul's going to hold out a little bit longer before he starts cutting rates. And I do think he's going to start cutting rates before his term is up because he wants to exit, I think, because when is his term done? Next
Early 26. I don't know.
Yeah, spring or summer of next year.
Yeah, it's soon for sure.
Yeah, so I mean, it's less than a year from now when his 14-year term is up. And I got a feeling that he's going to want to be, on his exit, the guy who saved the economy.
Yeah, that could be right.
And he also doesn't want to go down as the one that, Trump forced out. So he wants to say, I fought, I won, because I know the economy, Trump doesn't. I think that's the game that's being played right now. But I don't want rates to get cut from a financial standpoint for the economy overall, because I think the housing prices need to stabilize and come back down. But if they cut rates, prices are going through the freaking roof.
Yeah, I really love what you're saying here because this is you and I agree, it seems like, on a lot of things. I totally agree with you. My concern here, guys, is stagflation. So for the listener who doesn't understand stagflation, that just means when you have like a booming economy, like your inflation's really hot, it's really high, and you have high unemployment. So the two mandate is low unemployment, low inflation. That's really where the economy is booming, doing really well for consumers. So if you have the opposite of both of those, it's really hard to combat that, right? Because raising rates will slow the economy, but it's going to increase in unemployment. So it just makes it a very challenging economy to navigate because you have to choose which of the two mandates am I going to attack. And we're sort of starting to see that a little bit. So that's my concern. And if you hold rates steady, at least you're going to keep inflation under control. So I think you could hold off stagflation. But I'm not an economist. I don't really know.
Well, neither do the economists.
Yeah, that's true. Yeah.
And it's all an experiment for them too. They're making assumptions on stuff that nobody, I don't care how great of an economist you are, the economy itself is too unpredictable, too massive. Some small little technology change can have a dramatic effect on the economy. So how can anybody predict that?
Yeah, that's fair.
Yeah.
Right. Somebody, there might be another war or skirmish overseas that could definitely affect the economy in one way or another. Who knows? There could be a volcano going off in Hawaii. Oh, wait a minute, there is one. Right. There could be another tsunami.
A pandemic
there's so many different things.
So many things, yep.
What their job is to, the economists and well, I shouldn't say the Fed, but the economist's job is to try to predict what the economy is going to do based on what they're reading out of the economy right now. And it's like calling in 3 different contractors to get 3 different bids on a property. You're going to get 3 different bids for the exact same outcome. You're going to get 3 different responses from 3 different economists for the exact same outcome based on the exact same information. We all have, it's just a guess at this point.
So here's a point.
I look from the history of people who call themselves economists, how often are they right? Almost
Never.
never. They're worse
Never.
than weather forecasters.
Yeah. Here's a point I would like to make, and then maybe Sean, you tell me what you think about this, but the market has built in a 1/4 point rate cut. It's almost 90%. In fact, I'm looking at, let me look at it right now. 87.2% chance of a 1/4 point in September. So the market's built it in. So if they get that, this is a point I want to make. If they get that, I don't believe there's going to be any impact to the economy in general,
No.
because it's already expected. If they don't get that, that will have an impact. What are you thinking?
Yeah, I would agree with you on that. And I would agree with what Mike was saying earlier. I mean, if they do cut rates more than that, it's the prices are going to come up drastically on homes. I mean, the median is still climbing right now. So if you lower rates and you start an influx of buyers, it's just going to jack the prices up even more.
Right.
Yes. Which is good if you're a landlord, and not so good if you're out there trying to buy, like most of our listeners are actively acquiring. So maybe not such a great thing. Cool.
Yeah, and speaking of buying, I just had that conversation 2 different times now in the last 2 days with 2 different people, saying they're all saying that they have to lower the rates because this is the hardest time it's ever been to buy a house. I'm like, are you kidding me? This is probably the easiest time in human history to buy a house. And I remember back when my grandparents, when they bought their first property, they needed cash to buy the house. There was no such thing as loans. They couldn't get a loan. And what the cost of the house is, yeah, it was $8,000 or $10,000 to buy the house, but that was 3 years worth of income for them.
Yeah.
So they had to save up for 10 to 15 years to come up with the money to buy a house.
Mm-hmm.
And then, then they owned it free and clear, but they had to do that. And then when I got started in real estate as an investor and as a realtor, there was no such thing as 5% down, 3% down. You needed 20% down, or you were not buying a house. And the houses back then were $250,000 in my market, so half of what they are now. But we're talking 30 years ago. So even at $200,000 down, you needed $40,000 for a down payment. Well, today, what do you need for a down payment? Like 0? I have bought 2 houses now. I'm closing on one next week, so I just got on a contract. And I bought another one about 2 months ago where I'm taking over a second mortgage. So I bought them sub 2s, and I'm taking over a second mortgage, and that second mortgage has no payments or interest. And it turns out those were the down payment assistant programs. So the buyers got in for no money down. And guess what? One of them has a Section 8 voucher. So
Good
they have a
buys for you.
Section 8 voucher, and they got in for no money down on a property.
Yeah. See, when you're talking about something that's really cool, because you could literally pay more than a house is worth if you get some creative financing like that. I mean, you got a loan that you're taking over that has 0 interest. That increases the value of that house significantly.
Well, no, I mean, like they have a second loan for like $20,000. That was the down payment.
Yeah, but you got to take it over, right?
Right, I got to take it over, but I don't have to pay it off, and it just
Right.
sits for.
That's what I'm saying.
Well,
so
that
you're
was the
able-
down payment that the buyer didn't, that they were supposed to make, but somebody else gave it to them. It was like some type of a grant for the buyer out of their pocket. Now I have to pay it someday.
Right. Yeah, so I understand exactly what you're saying. I just want to make sure that the listener does. So you say sub 2, and we've talked about it on the show before, but if you're new to the Real Estate Educators podcast, you might have no clue what Mike is talking about. So in 2 minutes or less, tell us what you're talking about.
Oh, subject 2 is the legal terminology for buying a property and taking over a mortgage without paying off the mortgage. Right? And so the reason why it's called subject 2 is because when title is transferred in the deed, as well as in title insurance, but on the deed it'll say the seller, the grantor, is granting to the grantee the property with clear and free marketable title, subject to the following exemptions. And then that's where, if we're not paying out the loan, we just put in there that we're leaving the loan in place, right? So they're giving me market title, but it's subject to the fact that there's an existing loan staying on the property that I'm now responsible for because I'm taking it over.
So do you teach this type of stuff, these types of transactions at your meetings?
Oh yeah, that's one of the primary things that I teach is the creative side of things, whether it's sub twos, contracts, options. I create all that creative stuff, but that's a
Cool.
big focus of what I do is in my business is subject to. Like I just got 2 of them under contract this week, uh, and going to closing in a couple weeks on there, and then I just did a long-term option on another one that I was working with the seller. They have high equity in the property. They needed more time, so they gave me an option to buy the property. But I'm waiting 6 to 9 months to close on it. So another creative strategy, but I've got it locked up. So when they're ready to move and they get their job transfer and they're gone, I'm taking over but I'm doing it subject to.
So these are the types of strategies that are effective right now. The real estate, your tool bag needs to be evolving, because as the market moves, you need to pull out a different tool. So right now with high interest rates, and you're able to go in and take over something subject to at a low interest rate, that's a way you can create value, create profit sort of out of thin air. So I like that you're teaching these in your stuff. So I want to make sure that our listener knows how to go out and learn about this and learn more about you. So don't let me forget, but let's learn more about MidRIA. Quickly, I'm going to shift over to Sean. I read some reports occasionally about the fix and flipper sentiment. So they're sort of like surveys, and they come out in these reports. And for the first time in a while, I'm starting to see more confidence come back in the fix and flipping market. As far as the economy goes, like there's more stability in the economy. They're not as fearful of the tariffs and some of the other things that we were a little concerned, the mass deportation, that sort of thing.
Sure.
But fixing and flipping is way down nationally, and it's because of the costs of material and labor, because of what the fear was before. Now it's here.
Sure.
And so we're seeing fixing and flipping had a pretty significant drop in that sentiment. What are you seeing with your clients that are out there fixing and flipping? I know you have a lot of clients doing that.
Yeah, it's interesting you say that. I noticed it seemed like most of June and maybe the start of July, things pulled way back. There wasn't a lot of activity as far as us seeing deals come in for fixing and flipping or anything like that. We still had some new construction stuff coming around, but the fixing and flipping seemed to take a little bit of a leg, and that was exactly in line with when everybody was kind of unsure of what the tariffs were going to do and all that. But now in the last month and a half, I mean, we're getting activity for new deals coming in like we haven't seen in probably almost a year, I bet. I mean, it's coming fast and furious right now. Even with the higher costs of labor and material, people are still able to find deals, and it may be more off-market deals, but they're still finding them and bringing them in, and we're as busy as ever right now in this market.
Yeah, Minnesota or Minneapolis specifically, that market's still pretty hot. I mean, it's one of the strongest in the country. So let's talk about that, Mike.
I have a question for Sean on that.
Yeah.
Go ahead.
So you saw that leg or pullback in May, June, July. Are you contributing that more to the investors' fear of the tariffs and that aspect and the inflation, or could it be the sellers' unwillingness to move the properties at that time?
It could have been a little bit of both. I think it was. I think the experienced investors weren't as concerned with the tariffs and things like that, but people, maybe newer to real estate investing were kind of being a little more hesitant of it, just because they were listening to the media and if you listen to them, you're in panic mode 24/7. But it could have been a little bit of both, with the sellers being a little more hesitant to move it and just seeing what things would do. But whatever it was contributing to that must have subsided some, because like I said, I feel like I'm getting people calling almost daily with deals coming in. So,
well, because I've been thinking a lot about this as well, and because I noticed the exact same thing, not even from the flipping side, just in general.
yep.
I noticed this spring and summer, I didn't have a lot of activity going on. We weren't, through the RIA, I wasn't seeing a lot of activity. I mean, there was times where with MinRIA, we have property listings that get posted by our members. We were going 2-3 weeks without seeing a new property being listed, and we're at my office, we're struggling to try to figure out what's going on. And even at the meetings, people or has and want sessions that we bring up, we're burning through them real quick, like in 10 minutes. And you've seen them, you
Yeah.
shut them off after half an hour. Well, this month I had to shut them off. So this
Yeah.
month we had a lot coming up. And the interesting thing is in the last probably month, I've picked up 4 deals, right? Whereas the previous 4 months I picked up 0 deals.
Yep.
And the ones that the sellers that I'm talking to right now, we're trying to sell during that period. And they've gotten to the point where they got frustrated because, and this is what I'm trying to figure out. Was it the investor or the buyers that were holding back, or is it the sellers? And I think it was a combination of both, whereas the buyers were wanting, but they wanted lower prices, and the sellers were staying high. And enough time has gone by now, the sellers are like, I got to do something. And the buyers, because they couldn't get the sellers to move down, have stepped out. But I'm in the market, and yeah, for me, it's been fantastic the last few weeks. But I
Yeah.
did that stretch there where I was getting frustrated because I couldn't get an offer accepted.
Yep.
Yeah, that's a good point, Mike. Maybe it's a combination of confidence and just this seller's stubbornness. Is that the word I'm
Stubbornness.
looking for?
Yeah. Yeah. I would say that.
Maybe it's a combo. The
Well,
thing about
one house that I am buying is what she had the house on the market for 3 months and had a ton of showings and had no offers. Now, partly I know part of the problem is she's upside down. She's one of them that had that 0 down. So the house is now it needs a lot of work, and I don't understand how the hell she got the grant money to buy the property for no money down, knowing the property needed that much work, and she was getting grant money which means she has no money to put into the property, and now that she needs to sell, she's upside down. And I think the buyers are coming through looking at it saying, okay, well, I'm not even going to bother making an offer because the seller's way up here where we need to be down here. And they weren't even bothering to make offers, even though they were looking at it. So that's why the seller finally came around and said, and this one came to me from the realtor, because I'm not working with the realtors, say, hey, if you got the situation and it's been on the market for 3 months or whatever, you're getting showings but no offers, or the seller, can't lower their price where the buyer offers are coming in at, give me a call. And that's where I got this lead, was from a realtor, and said, I got a seller that's desperate and going through a divorce and she can't afford the payments anymore, and she needs to move on. Can you take a look at the property? I'm like, all right. Then I made my offer, and then that's when I found out what her numbers really were. I'm like, okay, the only way I can do this now is subject to.
and
So,
and she's taking it because it's helping her. So you're
right,
solving a
'cause
problem.
she wants to save her credit at this point, so she's not behind on payments yet, but she's like, I can't make a September payment.
Oh yeah, you need to close fast.
Right. So she signed the PA yesterday, and we're going to close on it in about 10 days.
So, Mike, I do want to get into some details of what's going on in your backyard and Sean's backyard as well. So while you're pulling this up, I'm just going to say one thing I noticed based on what you said with the sellers coming off their price. So if I'm looking at a percent of original list price received, so how much did it sell compared to what it was listed at? Right now in July in the 16 county Twin Cities region, it's 99.3%, which is 0.2% less than it was a year ago. So it's very consistent list price to sell price. So I don't know. I don't know if that's telling us, if what you're saying is true, then I guess they're listing it at a more reasonable rate, or is this just some phantom thing and they're getting the prices that they want? That's tough. I don't know the answer to that, but that just stood out to me. There's no movement in the list to sell price from a year ago.
Yeah, so and the nice thing about this report, the percentage of original list to price received, is it's an indicator to when the seller is in line with what the buyers are willing to pay for the properties on average. So the historical norm is 97%, which means the sellers are asking what the buyers are willing to pay. At 99.3%, that means that on average, the buyers are willing to pay a little bit more than the sellers are asking. Right. So like, I know you would intuitively think that 100%, like if you look at, let me see if I can zoom in on this
Yeah, help me understand that because I would think that it's 99. The way I read this is let's say it's listed at 100,000. They're selling it for 99,300. So 99.3% of list price is what it actually closed at. Is that not accurate?
Yeah, so 99.3% of what it closed at, but you got to remember most of these transactions, I mean, not in your world, from the hard money lending side of things, but in the traditional world where they're getting traditional financing, FHA or conventional with some seller concessions. This doesn't reflect the seller concessions.
Right. So
Whereas,
you're assuming a concession of 3-ish%.
yeah, and a little bit of negotiation. All right, so there's usually going to be some negotiation on price and or concessions, like
Yeah,
like a seller is paying the buyer's closing costs, or maybe the buyers are asking for a new roof on the property or a new appliances or something like that, where the seller's adding some kind of concession to get the close. And what they do is they up the price. All right, so we would think 100% means that, oh, they were asking 100,000, so they got 100,000. No.
Mhm.
Some people were asking 100 and got 100. Some people were asking 97 and got 100. Some people were asking 110 and got 100. Right.
If we were not going to look at individual deals, we're just looking at this data. If
Right.
you're at 100%, that's a pretty accepted market. I think the sellers and the buyers are in line. They're in
Correct.
agreement.
They're in line, but that doesn't mean they're getting exactly what they're asking.
Yeah, right. Yeah, the concession is a great argument. I didn't think about that. That is probably not included in this.
No, that is not included in this stuff, and most people miss that. And a lot of transactions have some type of a concession.
Right.
So I look at 97% being 100%. Just because that's always been the historical norm. So when you're in a neutral market, it's going to be around 97%, which means that the buyers are maybe asking a little bit less than what the seller's at. So I would consider that to be closer to 100%. When you see 100% or more, 98% or more, that means that the buyers are willing to pay what the sellers are asking or even more than the sellers are asking.
So it's tilted in the seller's favor right now, based on this one data point.
Mhm.
Right, and that's because we still have low inventory in our market. That if the inventory levels were in line with the interest rates and everything else going right now, we'd be below 97% if the buyers had an advantage. But being above 97%, the sellers have the advantage right now.
Yep. Okay. I do agree with that.
And that I see it changing, but you can see, for several months we've been hanging in that upper 90s, even at 100% number for a while. So yeah, we dropped off that a little bit, but not a lot. But this is where I'm starting to see. Now, this is the first time I'm actually looking at the July numbers, because usually by the time we do these, the data's been out for a little while, and I've looked at it, and I pulled these up last week, and the July numbers were not available yet. So I thought, well, I'm just going to see if the July numbers are available before we start today, and sure enough, they were. So this is the first time I'm seeing it live with you guys and analyzing it with you guys.
Okay, cool. Yeah, not much of a surprise here, though, I wouldn't think, because Minnesota I keep saying Minnesota. I got to be better at that. It's Minneapolis, the Twin Cities, has been very strong and consistent, despite the high interest rates, despite all the noise. It's just been chugging along.
Well, and you can say the whole state, because everywhere I look at stuff.
Okay, fair enough. We're looking at the Twin Cities area, though.
Right.
These numbers
are specifically Twin Cities. Yeah. Median price was coming in right where I expect it to be. We're at $395. Now, we've had some conversations about this the last several months because some interesting things happened this spring, and this gets along the lines of what Sean and I were just talking about a minute ago. If you look at, I don't know if you guys can see on the right-hand side of the screen, back in February and March, the median price was 380 for the Twin Cities, right? March should almost always be higher than February, but it wasn't. But then it had a pretty big jump from March to April. It went from 380 to 399.9, right? And that I expected a jump. I was like, okay, so maybe that had some pent up demand that didn't get pushed through in March. So maybe there was some weather or something else I'm forgetting about. that maybe held back some transactions in March and that got moved or pulled into April. But then look at May, it went down to 395. And I don't recall that ever happening in our market where May's numbers were lower than April for the median price. I mean, it might have happened. I just don't know when. I can't remember when.
Yeah, it's interesting how when I'm looking at this, and I just got to say, I hate looking at it month over month, because if you get a few, multi-million-dollar transactions, that could change everything. So a year over year, I think, is a better way to look at it. And I mean, it's easy to see that when I'm looking at this right now. It's all over the place. It's going
Well,
up, down, it's all over the place.
we have such a large enough volume of transactions that a couple multi-million-dollar transactions is not going to make that big of a difference in our market.
Okay. Well, something, and it's not just seasonal, something's impacting it because it's going down, as you just pointed out, in May when the buying season should be gaining some steam and the median value is going down. Now, what we're not looking at here is transaction volume. So maybe I'm
Right.
being unfair, but it just,
Well,
the month over month is there's just not a lot of meat there. But if you look at it a year over what it was doing last year, I think it's a more accurate picture of where the market's at least been headed.
yes, but I'm looking at it from the month over month right now because I've never seen that kind of a drop or stagnation is as long as we're still going up. But then June came in at 401, which is not really a strong bump over May. But we did break the 400,000, and I did predict that June was going to be our peak because most years, either June or July is our peak. And so based on what I've been seeing for a soft market this spring, and then seeing that we came in at 401 for our peak in June, I kind of predicted that we would see a pullback to just under 400, which is what we did. But if you look at the graph down below, because Minneapolis, Minnesota, actually most northern cities do have massive seasonal adjustments. Like you go down south, like I'm down south right now. I'm sitting at a hotel down in Atlanta. I can go speak at the RIA down here tonight. But if I was to pull their numbers, they might still have a straight line going up, but it wouldn't be up and down, up and down, up and
Right.
down. The cars is up and down, up and down, up and down. Even though the peak is higher than the previous year, and the valley or the low is higher than the previous low of the previous year, the trend line is still going upwards. But you very rarely see a May. I don't think I've ever seen a May less than the April number, and I've never seen a June less than the May number. So June and July are usually our peak. So this year is going to be June, and I think most years is probably in June as well. And those are closed, not when they went pending. Those are the ones that went closed. That means people were looking at them and getting them under contract in April and May.
This episode is brought to you by Pine Financial Group. Pine Financial is a private lender specializing in short-term rehab lending to real estate investors. Got a property that needs some love? We can help. We are able to offer funding solutions because we raise private money from individual investors. With more than 15 years of experience, Pine offers passive investors an alternative that provides stability, consistency, and security to your portfolio. If you like real estate but want to avoid the ups and downs and effort, a Pine mortgage fund could be a perfect fit for you. Accredited investors will experience an 8% preferred return and profit sharing. Diversify your portfolio out of Wall Street and into Main Street with a Pine Financial Group mortgage fund. Get more information at pinefinancialgroup.com. That's pinefinancialgroup.com. I don't know what you think about this, Sean, but I hate trying to time markets. Any market. Real estate is no different than the stocks for me.
Yeah.
And when I look at this and I talk to Mike, I'm like, man, is there something I could do as an investor? Should I be buying in January and selling in June?
That's what I tell people.
Yeah, I mean, in my eyes, it's the best time to do it. Best time to buy is right around the holidays, because then by the time you get it finished, you're hitting a hot market as it's coming around in spring. Especially here in, like Mike was saying, the northern cities where you do have that fluctuation. I mean, it isn't really timing the market, but it is taking advantage of a trend where usually the spring market ends up being hotter. So
yeah, and I also tell investors that be cautious right now, especially if you're working on really thin numbers. Like if you're following the BRRRR strategy, and you're planning on buying the property today, and then fixing it up over the next couple of months, and then going out and refinancing it in 6 months from now, your comps that you're using today, if you're running on thin numbers, are based on the May and June numbers. And then by the time you go to pull a refi out in, say, February, you're looking at the December, January numbers, and those are the bottom. And a lot of times investors can't refinance at that time. And they've made a commitment to either a private lender or a hard money lender to have them paid off by March of next spring. And they can't, now they need to wait another and do a 6-month extension and wait for the values to come back up and then pay for another appraisal. So another $400 or $500 on an appraisal when the values do finally come back up to get that refinance to pay off their hard money or private loans.
That's it's something else you just brought up. This is the second time you did this to me today, Mike. You're bringing up something I didn't even think about. But we all know that comparable sales is how we value real estate, at least in the single family space. And we also know that that data is old the very second it's used because it's all historic. Now, somewhere like Minneapolis, where there's clear seasonality, we got to be very careful with it. I know I'm just repeating what you just said, but I want to make sure that the listener hears this because this is very important and it could have an impact. So just understanding that the comps you use are 30, 60 days old, and it might be June comps, which are going to be your potentially your highest comps. So know that, one, and then two, if you are listing it for sale and your backup strategy is a refinance, this is something I see people get caught in. Don't list the property under what you think you want it to appraise for, because it won't appraise for that. If it goes in the MLS, you have that exposure and it doesn't sell at that price, it's not worth that price. An appraiser cannot, like, ethically, they can't say it's worth more than it didn't sell for. So don't drop the price trying to sell it and then switch to a refinance strategy and hope that you're going to get a higher appraisal. So 2 pieces of advice there.
Yep. And this is, the last several years, people don't have to worry about the seasonality because we had such great appreciation that it didn't matter.
Good point.
But now that we're seeing the market soften, I think this is where people can get caught in and get into trouble. And we saw very, very similar things happening in 2018 and 2019. So even if you look back on the graph down there, you could see the seasonal adjustments were smaller. Okay. Well, I remember prior to COVID, where investors were coming to me saying, where do I go get financing? I try to get a loan because they're doing the BRRRR strategy, and I can't pull out enough to pay off my underlying hard money loan / my credit cards that I spent to renovate the property. What do I do? I'm like, well, if you would have followed the Mayo formula, you'd have been perfectly fine. But they were all violating the Mayo formula because they listened to Bigger Pockets and told them to ignore the Mayo formula, just go buy the damn property, fix it up, and then get a loan from the hard money lenders, and then go refinance it. And then all of a sudden in 2018, 2019, for about a year and a half, I had a lot of people come to me and say, well, what do I do? I'm like, well, sell me the property, I'll buy it from you. And I bought a few of them from investors for less than what they owe, so I can pay off their underlying loans and save their credit and get them out of their trouble. And then COVID hit, and I thought, okay, this is going to get bad. And boy, the floodgates opened then. And then anybody and everybody could refinance at that point.
Yeah.
Yeah. So the Mayo, maximum allowable offer, that's typically used for a fix and flip, but it's fantastic to use on anything when you're using hard money. But it's tricky when you're doing a BRRRR, buy, rehab, rent, refinance. If you're doing that strategy, the Mayo alone is not enough. This is just my opinion here. You got to look at your cash flow requirements, what you want to make on a monthly basis, and the Mayo to make sure that you're staying safe. So it's really a 2-step process to underwrite a BRRRR strategy. And if you do that 2-step process, you will not be in the position that Mike is talking about with some of his sellers. And we have shot videos about this, exactly how to underwrite those deals, so you know that you're buying at the right price. And so all of that's on the YouTube channel, just YouTube.com/Pine Financial. So I know I'm throwing a little plug in there, but I am seeing the same thing you're seeing, Mike. So I wanted to throw that in there.
Well, I haven't seen it yet, but I'm predicting we're going to start seeing that again over the next year here. That I'm going to start seeing people calling me and say, what do I do? And the only thing that's going to save that, lowering the rates.
Yeah. Which may or may not happen. And I know we're coming back to that full circle. If they lower the rates, let's just pretend they do, which they're projecting to. Yes. Let's say they do that. It's not going to have an impact on mortgage rates. In fact, the last time they lowered rates, mortgage rates went up. So let's not get too excited here.
Well, what it'll do, because like you mentioned earlier, the market's already priced in 0.25%. And you can see that because we've come down basically 0.25% in the last month. Right. So
The reason for that isn't the short-term interest rates. The reason for that is what we call a flight to quality. People are selling equities and buying bonds. And when you buy bonds or you buy debt, the 10-year is the staple for the debt markets. So when money goes into that market, rates, just because of supply and demand, rates come down on the 10-year. And the 10-year plus a spread is what the 30-year fixed rate is. So when you see that 10-year come down, your mortgage rates will come down. So that has everything to do with liquidity in the market and nothing to do, very little to do with short-term interest rates.
Right, but I'm not an expert on this, but my understanding is when that's coming down, that's basically the market predicting that the rates are going to come down. That the short-term
Either that, so they're trying to get in to lock in rates now. That is part of it, or there's some concern about the stock market. And they just want to get into a safer investment. It's one of those two.
Okay, well, all I know is every time that the rates go down before the Fed makes an adjustment, as long as the Fed does what the markets want, nothing happens. If the Fed does something different than what the markets were predicting, based on the 10-year bond market, the market reacts. And you have
and I think that's why sometimes you see an inverse. So if they don't stick with me here and tell me if I'm off my rocker, but if they don't change the short-term rate, which everyone is projecting, that would have an impact on confidence in the markets. Right. So I think you would see a reduction in the stock market because of what I'm talking about. They would move into debt, and at that point rates would go down. So it's possible that rates could stay the same or go up on the short term, the Fed funds rate, and mortgage rates do the opposite. It's just because of how the money moves in the markets. The only reason I'm saying that, guys, is because I don't want people to think that if they get the quarter point that we're expecting, that your mortgage rate's going to go down. That's not the case.
Well, here's an interesting too, because a couple people that I follow that I actually put more stock or more weight in their opinion than a lot of other people. A couple of people that I follow now are saying that they're thinking 1/2 to 3/4 of a point in September.
That's possible because the market actually is projecting a total of, they're calling it 4 cuts, but there's only 3 meetings. So that's weird. But what they mean when they say 4 cuts is 4 quarter points. So
4 quarter point.
There could be a half in there somewhere, or maybe a 3/4 and another quarter, something like that. So I agree with you.
And they don't have to have a meeting to cut rates.
Yeah, if there's an emergency, like if you get another crazy jobs report or something, they could do an emergency meeting. That is true. It's pretty rare though.
Yeah, it is. Well, it's rare, but it's happened quite a bit in the last few years when they were raising rates. They were doing emergency rate hikes in between Fed meetings.
Yeah. I would not suspect, with the way the data is sitting now, I would not expect that.
Yeah, I'm not expecting
possible.
Either. I'm still under the belief right now that we won't see one in September, but we'll probably see one either later this year or first part of next year, is my gut feeling. But I'm not an economist. I don't pretend to be. I don't play one on TV either.
Yeah, neither am I.
I
didn't mean to derail you. I just want to make sure we're adding value to the listener. And I hear this, like the rates are going to go down. Yay, I'm going to refinance my home. Well, to your point, there is a correlation, but it's so long. The outlook is so long between a short-term rate and a mortgage rate, the 10-year. It will eventually. They always tend to go the same direction over time, but it's not going to be like, okay, next month I'm going to be refinancing. That's all my point is. I'm going to look at the. I'm just going to go to U.S. News. If it lets me, this is the projections of mortgage rates by some of the top economists. So this has Fannie Mae, the Mortgage Bankers Association, and Wells Fargo, and they're expecting 2025 to end pretty much right where it is now, about 6.5%.
And what are we at right now? About 6.5.5, 6.6.
Well, it depends on what you look. Let me see what 6.6% according to AI.
Okay, that's what I saw yesterday too. Then, all right. I wanted to pull up the pending sales for the Twin Cities because pending is up a little bit. So for July, so that's a good sign. And that again gets back to what Sean and I were talking about earlier is the settlement. Usually in July, we don't see a big increase over the previous months. We usually see a decrease, which we did. We saw a little bit of a decrease, but it's still higher than the previous July numbers. Right. So I think we've been seeing some holdback in the spring, and I think we're seeing more activity now.
Yeah, it looks like it.
And then let's go look at new listings. Okay. So this is the first time I'm looking at the new listings numbers as well, and that is actually up. It's not up to the May numbers, but it is up. It's 5.8 year over year, but it's up month over month as well a little bit. So June was 6,566, and July is 6,770 new listings. So I have a feeling that the sellers are starting to loosen up a little bit more. But we'll see. I mean, and if they really are, I think we will start seeing that percent of original list price come down too.
Yeah, if inventory keeps going up at this clip, you will see that. Well, let me ask you this. Almost 6% year over year increase in inventory? That feels like a lot to me, which is healthy. It's exactly what the city's needs. But what do you think? What do you normally see? Is that a pretty significant jump?
No, it's not a significant jump. It's just this time of the year, it's a jump that I wouldn't have expected. I would expect it to stay steady or lower. And I guess you could say it almost is steady from month over month numbers. Year over year though,
Well, it's going up at more than twice what the median values is going up. That's why I'm saying it seems like it's a larger clip than I would normally expect to see with where the values have been going. Because look, values are driven by supply and demand, and we're looking at supply
and interest rates,
which creates demand, right? That impacts demand.
Right. So I don't know. It's at this point that's not a number it's not a big enough jump for me to make any speculation on. But I do know our overall inventory is still low.
Yeah, I agree with that. I do agree with that.
Well, yeah,
That's why I was saying this is healthy.
Months of inventory at right now? Has that adjusted at all?
It's basically flat year over year, so we're at 10,000 now.
Okay, what was that last one we were looking at? I thought that was inventory we were looking at.
No, that was new listings.
That was listings.
Oh, that's just new listings, not the active supply. Yeah. Okay, so this one makes more sense to me. That's closer to the median value increase. So this actually makes a little bit more sense to me. It's about 2%, which is where you're seeing appreciation right now.
Yeah, now from a historical standpoint, we're still 50% of what would be considered a neutral market for the Twin Cities.
Yeah, I agree.
However, we've been so low for so long, those numbers are almost artificial. Like, because for my whole career in the Twin Cities market, we've been in the 20,000s at all the time. But we've been, below 10,000 for a long time, at least hovering around that 10,000, which is about 50% of where we used to be. But that's now the new norm. So what's going to change that? I don't know.
Yeah.
Is that really the new norm, even though our population has grown? That tells me people aren't moving like they used to move. I remember back in the day, I was taught that, the average family moved once every 7 years, 5 to 7 years in the Twin Cities market, and most of the country once every 5 to 7 years. Well, now it's like they're moving once every 20 or 25 years based on these numbers.
I think there's some lock-in effect here, and I don't love that argument, but there is some truth to that. I mean, people are not paying off their 3% mortgages.
When did rates really start climbing?
2022.
I want to say was it in the early 80s or late 80s?
Oh, you're talking about the last one.
Back the last one.
Yeah, so it was more like mid. So that was after the savings and loans. So you're looking at early to mid 80s, and it went for a while because it created the crash in the 90s. So there was a good run there of double-digit interest rates.
When I got started, the rates were still climbing, and we were still selling houses. So the rates were climbing higher than they are now. Mm-hmm. So we were doing loans where people had to sell to come at 20% down. Yeah. And they were getting loans, they they're moving into 13, 14, 15, 16% loans.
Yeah.
Yeah.
Yeah, that's interesting. I hear what you're saying. And we didn't have a starting point of 2.8. So there
No,
may
they
be a
started at
different,
8 and they got up to mid-teens,
right?
Mhm.
but they were still selling. And I think it's the same thing as right now. It's when rates go
Yeah,
up and
it's
you
interesting.
get these lock-in effects, people still move because they have to. Divorces, job transfers, can't afford it, lifestyle changes, getting married, death, marriages. There's all these different factors that are going to come into play. We're still seeing the same thing right now.
That's why I didn't love my argument. But
You prefaced it before you made it.
but let me say, and you tell me if you guys are hearing something different, but I don't talk to people that say, yeah, I'm excited to go out and pay off my 3% mortgage. I mean, people that I talk to, I don't know what the data says, but they want, and I'm the same way. I don't ever want to pay that thing off.
Yeah.
You know, I'm going to live in my house until, well, forever, maybe. I don't know. I hear what you're saying, Mike. And I think maybe the data is, especially with the interest rates stabilizing and people are starting to accept that. I think you're probably more accurate than me, but thought I
Because
would.
I've been hearing a lot of people call it the lock-in effect for a while.
Yep.
Um,
3 years.
but
Yeah.
the people I've been buying from for the last 30 years have never sold their property because of the interest rate. They've sold their property because now I will say that the spring market that might be lagging because of the lock-in effect. So you might get people that, because the most busiest time of the year is traditionally the spring market, and that's because families that went through the holiday season, they realize, their house, their family's growing, they need a bigger house. They usually wait till the spring market to start looking so they can close on the property early summer when the kids are not in school. Right? So that's why our spring market. I can see where that would probably come into effect. But for me in my business over the last 30 some years, I've been more active in the fall and winter for buying and selling because that's when people like, okay, we need to move. We're getting a divorce, we're getting a job transfer, whatever. We need to get this, we need to move this property. We can't afford 2 payments. Right. So from the investor standpoint, I don't see a lock-in effect thing. And I am buying properties from sellers right now and taking over. They're 3 and 4%. I got one of them right now. I got is 3%. Another one I got is at 4% or 4.2, and the other one's at 4.5.
So that's making my argument for me, Mike. So you're taking a property that potentially could be sell a 1 unit of inventory off the market and turning it into a rental likely. So
Yes.
there's other people doing the exact same thing, and you're doing that because you're getting a 3% loan. Like, of course, it makes perfect sense. So how many other people are doing that exact thing and keeping these inventory numbers lower?
Well, I'm just saying that I'm buying them subject to and taking over those low interest rates. They've got the low interest rate and they're still selling it.
Yeah, but
The
the
lock-in
loan,
effect is
the
that they won't even
lock-in
sell it.
effect is not paying off that loan. So they are selling it. It's never hitting the market probably. So it's never going to show up in this data. And then now it's going to be converted into a rental. So it's still not going to ever show up. So there was a transaction that never happened in this data that you're
In this
showing
data,
us
yes.
because of the interest rate.
Yeah.
My guess is that number would not work. If it was a 7 or a 6.5 or whatever percent interest rate on that loan that you're taking subject to, my guess is you wouldn't buy it.
Yes, I would. I just bought one.
Oh, it's still cat. Okay.
Yeah, I got one at I think we took it over at 6.8 or 6.9. And it's actually got some acreage with it. So we bought it not because of the interest rate, but we bought it because of there's additional value to the property somewhere else that we can use. So I'm always analyzing every property differently.
Okay, so that's different. To buy a rental property right now at 6.5 is tricky. So the way people are doing is how you're describing. At least that's what I'm seeing.
Well, if you only look at the traditional side of real estate, but I'm not a traditional investor.
Got it.
Which is why when it was really easy to get financing at 3%, I struggled because I'm not a traditional investor. And yeah, I picked up a few properties, but not as many as we're getting now. And I'm getting way better cash flow now than I was before. Yet your traditional investors, they don't understand what the heck I'm doing. And their mind is blown when they look at some of the stuff and some of the cash flow I'm starting to get.
I literally think you're making my argument for me. You're successful now because rates are high and you're able to take over debt at 3%.
That has not
Right. When
my
the rates
point.
were low and there was no opportunity to take over that debt, you had to go get your own loan. Well, they were just selling it to typical buyers, so there wasn't opportunities for you.
But your point
So
was the
that
lock-in
is the
effect.
lock-in. That is the lock-in
No,
effect.
lock-in effect is okay. Then
Sean, help me out here.
Then
Well,
why was
What do you
everyone else?
think?
I'm
Why
gonna
was
be
everyone
interested
else
in
buying
you
when the
though.
rates
That's
were
the
at
thing.
3%?
I
And
was
I
going to say
couldn't.
that the lock-in effect, the only way I see it is it keeps people that are teetering, like they don't have a situation where they need to sell the property because they're moving or divorced or any of that. They're staying locked in because they're like, yeah, I mean, we can just stay in our house. We don't really need to move. So
I think
they,
the lock-in effect does affect the move-up buyer. Like, yeah, we'll buy it because we want to.
yeah,
Yeah.
But
I
how
think
many people actually
all agree
buy
on that.
because they want to, or is gonna, if they find their dream home, is gonna prevent that because of a low interest rate on another property?
All right. Well, let's look at the months of inventory. I know Sean was asking about that. That's a pretty
Uh,
good indication of the economy. We talk about that every time we do these.
Month supply 2.7 flat.
exactly the same.
Yep, coming
It's
in
pretty
flat.
strong. This is exactly what I'm talking about. Minneapolis just keeps chugging along.
Yep, so we're still below 4%. That's still a seller's market. Now, I'm looking at some other markets that, I mean, I don't mean I'm looking to buy, just because I travel and I'm speaking at other RIAs. Like I'm speaking at the one here in Atlanta tonight. I haven't looked at their numbers yet. I was going to do that after we get done here. But a couple of the other RIAs that I spoke to in the last few weeks, I go and look at their numbers before I get there. I am seeing some other markets where their month supply of inventory is going up and they're getting in that 4, 5, 6 months range.
Yeah.
But their price and the days on market is really expanding as well, and they're getting into that 60 to 90-day range. But I'm not seeing dramatic price cuts. So I'm not exactly sure where all these price cuts are coming from that I hear everyone talk about on YouTube. Unless they're only talking about the high-end stuff. And most investors aren't working in the high-end markets.
Well, my next question was going to be what are the days on market now looking like in the metro here?
I think it goes around 40, if I remember right. I mean, that's up 11%, but it's only up 4 days. So 11% sounds like a dramatic increase, but it's 4 days.
Yeah.
But we're still lower than like even during the winter months where we're up to 60 days. It looks like February we even gotten to 69 days.
Yeah, February is almost 70. Yep.
Which is still lower than the historical norm, because the historical norm is 90.
Yep.
Because back in the day, as a real estate agent, I wasn't even concerned about a listing not selling until we got past 90 days. And in today's environment, people are freaking out because it didn't sell in 2 weeks.
Yeah, exactly. That's buyer or seller expectation, right? Which is sort of coming in line, you think?
Yeah.
That's what the data is saying.
Yeah, that's what the data is telling me, that the sellers are in line. In other words, the sellers aren't getting overly greedy right now.
Yeah, their expectations are more reasonable. Cool. Well, we've been at this an hour, gentlemen. Any last minute pieces of advice or something we should discuss before we end the podcast episode here?
The only thing I could think of is there's a lot of deals that are starting to happen now. So there's a good time to be out there. I'm excited about it. Like I said, we're moving a lot of stuff, but you do need to be a little bit more creative and look at alternative ways of buying and holding on to properties.
Yeah. And we're going to definitely figure that out with Minria. I want to make sure that everyone understands how to come and learn from you. Sean, you mentioned earlier that overall, there seems like there's some more confidence with your clients. You're seeing more activities. We're seeing that both on the buy and the exit when they resell the properties. Just a lot more. There's like a buzz, sort of. Like I just hear like people are getting excited.
Yep.
So anything you're thinking? What are you feeling overall?
No, I was going to say that same thing that you just said is, I mean, based on what we're seeing, there's deals to be had out there right now, and there is a lot of activity in this market, especially. So be on the lookout. Like always, stick to your numbers to make sure that it is an actual good deal. But yeah, I mean, it seems like it's still a very good time to be hitting it and seeing if you can find some good deals to get into for fix and flip and for the buy and hold side of it. So yeah, I would say just keep at it. And then the only other thing I was curious about is how much money Mike was going to put down on the if the rates are actually going to change or not. So
we're gonna have a little bet here, a little wager.
he said he would bet on it, but he's not going to bet a lot.
Yeah, like maybe a steak dinner or something.
Yeah, there you go.
So Mike mentioned that he's much more active in fall and winter, which makes perfect sense. We're entering that season now. Do you agree?
Yeah, yeah. Some of my best investors, their favorite time to buy is between Christmas and or between Thanksgiving and Christmas, so that they can get it under contract, work on it when it's cold out and you don't want to be outside here, and then get it back on the hot market in the spring.
Nice.
Yep.
Cool, Mike. Tell us about Minneapolis.
Yeah, so Minneapolis, we meet the first Tuesday of every single month as our main monthly meeting. We also have a lot of different subgroups and focus groups on different topics to fill other different niches. But it's where most of the investors in the Twin Cities get together on a monthly basis to come and network, talk, learn from each other, and meet other people in the industry. So first Tuesday of every single month, and it's at Minrea, MNREIA.com.
And I think the first one's free to come check it out.
Yes, first one is free for everyone.
And you keep telling me you're going to invite me in to speak again, and I haven't been getting that invite, but someday I'll get that.
Yeah, I think you've had the invite a few times.
It's been a little while, but it's okay, Mike. It's okay. I know you're getting some great speakers coming out, and Sean and the other people that are out there active in your community are learning a lot. So minrea.com, that's the place to go. Guys, a little over an hour today. Thank you so much for your time. I know you're both super busy. Mike, you're not even at home. You're down in a hotel room, and you still jumped on with us and hung out with us. I really appreciate both of you for doing that. This episode adds so much value to the listener, so thank you. And then obviously the listener, you could choose many different podcasts, and you chose the Real Estate Educators. And for that, we're super grateful. So thank you for tuning in. Please 5-star review, and I hope you make this day a great one. Hey guys, I hope you enjoyed this episode as much as I did. If you did, please be sure to follow and leave us a review. Oh yeah, and tell a friend.